Hey, greetings. Good Thursday afternoon, as Carl Quintanilla would say on CNBC. Nice to see everybody. By the way, just in case you were about to use some profanity, I kicked the recording off already because I didn't want to blow it. I can barely do 80% of one thing at a time, and we we have we're doing this in concert with Dennis Dick, Joel Elconin, Brent Slava over at Stock Trader Network, who's with us here today. It's an experiment, I think this could work well, but I wanted to let you know that we have kicked off the recording, and so know that you are being shown at present. Okay, so I'm going to give a few quick introductory comments, and those of you who attend all the time know these things. We want this to be very interactive. Ask us questions in the chat or interrupt us while we're speaking. If you can't, mute yourself. We don't automatically mute you because we want to make it easy for people to weigh in. And if you're joining from Stock Trader Network, I think Brent will see. If you have questions, he can chime in and we will try to address those. And we'll try to stick to 30 minutes here and be very respectful of time. The purpose of these things is we hope that we help, you longtime veterans, you know the platform well, but we share our insights and thoughts and how to use the platform. I'm going to do that in very simple terms today. And then market strategist Brian Wilson, I think he had 4 items. We always catch up with each other, ahead of time about what we're going to cover. And so I'll hand it off to you, Brian, to kick us off. So here's Brian Wilson.
Sounds good. Thank you very much, Tim. Apologies, everyone. My camera decided to stop working 1 minute ahead of the meeting, so I didn't have time to exit and come back in. So with my discussion today, I kind of want to paint in broad brushstrokes and kind of get us to where we're at this particular time. So I'll go ahead and share my screen, and we're going to start by painting in broad brushstrokes for big tech. And most of you are aware of this, but I'll give you an example of of what we're talking about when we talk about big tech. So if you talk about the Magnificent Seven, and if you look at that percentage down here at the bottom, and I didn't include Tesla, we're talking about 33% of the S&P 500. This is weightings for SPY. If you take the top 15, which is what you see right here, that's 43%. It's a very top heavy index. And I bring up big tech because we're having issues right now with big tech. And let me show you what this looks like. I'll take NVIDIA as an example. So what you're looking at right now, for you veterans, you'll recognize the green line is what we call market structure sentiment. It's our algorithm for demand. It's a 1 to 10 scale, and it will vary over time. You can see right now NVIDIA is exactly at neutral. Well, what we see over time is these demand cycles will change. We capture this for every single company. We capture it, for, of course, for the S&P 500 and basically the Russell 3000 at large. But when NVIDIA was doing well back last summer, May, June, July, down below here is NVIDIA price moving higher over time. You could see the routine is that NVIDIA would hit 10 out of 10. It would do that with consistency. Now, what we started to see in the latter part of the summer is those demand cycles started to break down a little bit. You can see that in the summer, it tried to take another stab higher, collapsed. What do we see right now? Well, certainly not what we saw back in April, May, and June. It's a very different demand cycle at this particular time. And it's part of the reason that the market is having difficulty so far this year. If we look at market performance year to date, S&P 500 down a little bit over 3%. We have 6 different sectors that are actually doing quite well. But underneath the surface, because big tech is struggling, well, it's dragging the whole S&P 500 lower at this particular time. in terms of discussion of where we're at right now, big tech is struggling. And what we started to see towards the end of the year, we caught some glimpses that we were starting to have some issues. What you're looking at right here is what we call broad market sentiment, broad sentiment for risk management. And it's the same principle as I just showed you with NVIDIA. I'm going to back this up to a 3-year look. And I want to show you what we were seeing at the end of the year. Here's those normal demand cycles that we have in the market, that consistency in terms of those demand cycles. What did we start to see towards the tail end of the year? Well, those demand cycles started to break down. And if you recall, October, November, December, when we were having these discussions, we were pointing this out and saying, hey, when we get to the beginning of the year, it could be a little bit of a rough start because demand is changing in the background. Well, what are we seeing so far in the beginning of the year? Once again, this is SPY up here. Well, it's broken down, right? We're down a little bit more than 3% here to start the year. So what we're seeing right now is not necessarily just a surprise. We started to see it in the broad market demand cycles coming into year end, and that is really, continued so far at this particular time. What you'll see here on the screen is you'll see a green line and you'll see a red line. We're talking about SPY, and essentially the way that you can think about this is the red line is stretched conditions for the broad market. It becomes difficult for the market to continue to post gains when broad market sentiment gets above the red line. When it gets below the green line, it becomes a buying opportunity. And we've just gone through one of the longest stretches, the longest stretch we've ever had in our data from back in April when we were below the green line up until now, and we just went below it just a few days ago. Now, what does it mean when we go through the green line? Sometimes it can be a quick bounce. The market bounces every single time. Now, sometimes it can be a quick bounce. You look back at December 2024, we went through the green line. We kind of muddied around for a little while, and then, and then the market went lower. It did bounce, but it was more of a short term in nature. If we look at some of the other bounces, shifting back to November, the November timeframe in 2023, look at that bounce coming out of those oversold conditions. Look at the bounce coming out of the tariff tantrum back in April. Now, these two bounces that I just showed you here, November 2023 and the bounce back in April, they had a couple of things in common. What they had in common is the fact that broad market sentiment was weak. And what they also had in common is the fact that big tech was really weak at the same time. And that's something right now that is a little bit of a difference at this particular time. I'll shift over to our big tech portfolio for just one moment to show you what this looks like. Big tech has started to deteriorate a little bit right ahead of options expiration. So this is big tech sentiment. Here's the companies that we have in it. And you can see that deterioration. Those two previous bounces that I showed you, big tech was really, really weak when the market started to bounce there. So what am I saying here? What I'm saying is I expect some type of bounce coming out of expirations, which concludes tomorrow. But my question is, what happens to big tech? Does big tech continue to deteriorate? If so, any bounce might be short-term in nature. We might not have a really long bounce. So I think as we look ahead, we're going to be very, very dependent on what happens with big tech. And right now, it's weakening in the background. And with that, Tim, I'll turn it back over to you.
Okay, thank you very much. Appreciate that, Brian. And for those of you who just joined, we're broadcasting this with Stock Trader Network as well. And so those of you who are tuning in that way may think, what is this? So I'm going to explain just a few basic principles for you, and it's my intention to keep this pretty simple, and for you veterans, it might be kind of basic. But the entire construction of Market Structure Edge, and by the way, you can sign up for our daily market desk notes that Brian and I write. We trade off, and that's free. You know, you don't have to do it. You can just read what we have to say. What make the entire basis for it is demand and supply. The most basic economic principle is that rising demand and insufficient supply tends to produce rising prices, and weakening demand with excess supply tends to cause prices to deteriorate. And so we look at that. You could look at it in any stock across the broad market, which Brian just talked about. If we have deteriorating demand and a whole lot of supply, what is the market likely to do? Well, it's not an absolute, but it's a very good principle. And it's not, with broad sentiment, it's not a precise instrument, but it will tell you basically what 90% of market cap is doing. It's the S&P 500. We use the proxy price of SPY to tell us how price is performing relative to demand and supply. They don't move perfectly, but it is a great principle that you can apply anywhere. And I'm going to give you some examples here in a bit. That is the core starting point. And the reason we do this, the market is not technical. I mean, technical signals have been around far longer than the mathematical nature of the marketplace. It's not that they don't work, but that what we've built here is reflective of the underlying mechanics and regulations of the market structure, how orders are handled, how money gets into and out of the marketplace, heavily regulated. It's very much a process, and it can be measured. And that's what demand is. Demand's an algorithm where we normalize the interaction of trade executions with different purposes and time horizons to understand, is demand increasing or decreasing? And it's because all stocks have to trade between the best bid to buy and offer to sell. And if money is buying, spreads narrow, and the average price increases, and you can see that, and vice versa. And supply is the data set associated with what's called the modified or alternative uptick rule, which was implemented in 2011. So effectively, all volume in the market is long or short. And so if it's absolutely, it's 50-50, then the market is neither long nor short. Right now, it's more short than it is long. It's 53% short, which means it's 47% long. The more short volume you have, the less probability there is that there is underlying natural buying and selling occurring from real holders of equities. And I won't belabor how we get to all these things, but it's all about the regulations. And these are things you can look up yourself. You can go look at short volume, naked shorting at the SEC, and they will explain this principle that just because there's a lot of short volume does not mean it's naked shorting. It is market making. It's designed to make sure that the market is a continuous auction. So that's the beginning point. Know what the big picture is. Is demand increasing and supply decreasing like we saw back here, and we had a nice run, it's volatile, or not? And then the next thing we want to think about is, what is the context? The stock market doesn't start over every day at zero. It had some point along an arc yesterday, and that arc will continue today, and there will be things that are occurring. And notice this. See this little square there, those little green squares? Those are vital turning points. Often the market does crazy things around those, and those are options expirations. There are options expire nearly every day, but the monthlies are very important because monthly options are used to true up how indexes are performing relative to a measure. We used to have a person on our client services team at our corporate business that we hired who used to be at BNY Mellon, where his job was to trade baskets of options and futures to true up indexes and ETFs. I mean, if everything's moving, you don't buy a whole bunch of stocks, you can fill it in up to 10% of your assets. with options and futures. Well, that's very important. In a market dominated by BlackRock, Vanguard, and State Street, passive money is about 64% of assets under management now. Active money that picks stocks is 36%. It's approaching a third of the assets. It will not determine the outcome in the market. And so these things become very important. And you can see the calendar. I'm not going to click it. Just click using Edge, and it will take you over to, wrong one. It will take you over to Market Structure Edge's landing page. Whoops. And then you can look at the calendar, the options calendar, expirations calendar. You can go look at the Options Clearing Corp, and it will have the same.
Oops.
Here. See this? So you have a whole bunch of things going on, and you could go look at the key down here and understand that there are not just one. It's not just Friday. It's Wednesday, Thursday, Friday. Yesterday were VIX expirations. Today are index options expirations used by big institutions. That's why VIX is green. Then that circle is on Friday. We have quarterly index rebalances. Very important stuff. And then we have the end of the quarter and the month and month-end options expirations coming up. So it's important to understand that those can have a big impact on how stocks behave. About 20% of market cap ties to derivatives. So a stock could lose all of its value, reporting results during options expirations. Get great case in point. If we looked at, I'll come back to this in a moment, but look at sale point. So what can happen to a stock when the company reports earnings during options expirations? Well, you can lose 20% of the value. Look at that. It's down 20%. It turns out sale point, that's about 20% of their market cap is tied to derivatives. It's important for you to know as a trader, an investor. These are periods where you have to expect a different outcome that might happen otherwise because a primary purpose has replaced whatever else is going on, and it's options expirations. So then we come to divergences. I'm going to put Cloudflare back up here. Ticker is NET because I want to illustrate a point. So it's at 220.44 right now. One of the ways that we use these data at Edge is to trade divergences. They're different purposes. And Joe, I'm going to come around to your question about the Take-Two focus model portfolio. One of the things that we do is we look at, what are the things that you could trade today with high probability? They're really the same portfolios that you see here, momentum and low volatility. But when we add probabilities to them, there might not be very many. So right now there are 8 in the momentum portfolio, and I'll explain that, and 5 in low volatility. That's not very many. Right there, that is a signal telling you it's very difficult to predictably trade things. If we have 30 or 40 in those combined portfolios, you could trade to your heart's content. If we look at these daily trading ideas, I had just put Cloudflare up. That's this right here. So there's no such thing as 100% probability. But when we calculate the likelihood that under certain conditions you could make 2% or more, in the trailing 90 days, it worked 100% of the time. Doesn't mean it will work tomorrow. But what we try to do is capture a portion of the volatility. When you have demand-supply divergence and you know how much a stock generally moves, could you capture a piece of that? Because you have a signal now that everybody else doesn't know. We're measuring whether people are buying and selling that thing and whether the condition in the market might be constructive for buying. And you can even calculate an entry range. It's fairly wide because there's a lot of volatility. But if it's above 220, well, that could be pretty appealing. And then you don't have far to go to make money. And if you could do that every day, it's a really great way to make money. It doesn't work all the time, but here's what it looks like. So if we look at the data for Cloudflare, the point isn't the closing price per se, it's how much does the stock move? And it happens because demand is very strong. It's 10 out of 10. We call that a momentum stock. And supply has declined sharply in the last number of days. Well, if demand stays strong and there isn't enough supply, price will rise. And so that's what you use to your advantage in 1 to 5 days. And it's in the entry range here. So at the end of the day today, keeping in mind, what is the context? Tomorrow is quad witching and index rebalances. New options trade on Monday. It throws the odds off. But I like to do this. In the last 10 minutes of the day, when I know everybody who has to have a reference price, all that index flows, the ETF baskets and so on, that I could buy a position and then at the next day, maybe even very close to the open, particularly if it's up 2%, you take your gain. Won't work every time, but it's a very good approach to because and the reason it works is because you know demand and supply, and we apply that principle everywhere. And to that end, let's take a look at two other examples here, and to make the point about demand and supply. We put 13, is that right? 13 portfolios automatically on your dashboard, but you can create whatever you want. And I have a home builders portfolio over here. And this is a 30-day demand. So demand in this group heading into February options expirations was almost 10 out of 10. And there are 9 stocks in it. And supply was low, it was below the trend. Well, they did really well up to that point. Then demand began to deteriorate and supply rose. And if you're holding this group, what you do is when demand drops below 5, you're out. Why? Because now there is no, 5 is the nexus. Below 5, we cannot count on what will occur. You can't count on it anyway, but it's a very, very good and mathematically reliable principle that stocks at 5 or better, particularly depending on what's happening with supply, perform well. Well, look at them now. I mean, I don't think I've ever seen this where all of the home builders, I think there's one that isn't in this group, but generally they're all here. They're all ones. Of course, they've all bottomed, but look at the supply side. So Meritage has 38% short volume, so it's the lowest of the group. But look at this: Hovnanian 75%, Beazer 75%. What's MHO? I can't remember. It's MI Home 72%, KB Home 72%, DR Horton 66%. Don't buy that group, right? Of course, it doesn't take a genius maybe to figure that out. You don't want to buy that until supply comes down. This group is 62% short. So it's a great way to know, well, I don't want to be in that. And if you were I'm going to use one other example here. How about industrials? It's one of the, it's a sector. It has performed very well at times. It's a very strong longer-term performer. And you can go in here, well, you can look at the first thing that you do is look at the demand supply balance. And you say over the same 30 days, good demand right into February options expirations, and it has deteriorated since. You do not want to be buying this because supply is trending up and demand is trending down. But if you went and looked at the group, you can make some determinations. Where might I get something good out of the group? I'm going to sort it by market cap because the money is biased toward large caps. 90% of assets in ETFs are in large caps. Go look at mid-cap funds. They own large caps. It's crazy. Money has to have size because it is so massive today at BlackRock, Vanguard, State Street, Geode, and so on. All these systematics that have to deploy money, and they need things that don't move and that you can get in and out of. Well, it's going to default to very large stocks. And if you looked at this group, you'd say, well, CAT is trending up, but it's 4.2. GE Verona's 4.2, trending up. Deere 2.6, trending up. So I mean, most of them. These top 15 or 20 that shows excess demand is VRT. It's 10 and it has less than 50% short. Well, you could go look at it and say, well, I wonder how that's doing. It's clearly it's been a great stock, but you can, it's just a very simple principle that you can use to always know what stuff is likely to be better. Well, it's up to $2 today, almost 1%. So it's bucking a difficult market. When that deteriorates, then you want to be out of it. But it's a very good, basic, simple principle. You don't have to look at charts. You don't have to watch screens. I don't do any of that. I just look at demand and supply, and it works very effectively. To that end, I'll conclude here. I was on pre-market prep. Let me get back to where I want to be. On Monday with Dennis and Joel, and Brent, you were there too. So, and I talked about this. I said, the problem heading into options expirations is that the market could be telling us with demand something different than what the prices are telling you. Don't trade price. Price is a sucker's tool. Price is set by Citadel, which always has better data than you do. They're always ahead of the market. I'm picking on Citadel, but it's that whole lot of what you could call high-speed quantitative investors with investment horizons of a day or less. And so you can get stuck holding the bag. So on Monday or Tuesday, you go, oh, the market's recovering. And we're looking at it and going, as I said, on pre-market prep, you can get stuck holding the bag because the market will rise into options expirations, even though we know demand is terrible and supply is excessive. And it's because traders can move options prices, and then you and I or somebody who knows less than us will buy them, and then you're stuck. And the prices collapse on you. So don't be fooled by that. Always check the broad sentiment and demand and supply, particularly at options expirations. Now, the good news for us is that oftentimes if the market does terribly into expirations, it does well out the other side. I don't know what's going to happen. My qualifier, and Brian, you can weigh in here too, because I think your last thing is to talk about what's next. Here is the issue. I'm going to do a 3-year view. The market always bottoms below 4.0, statistically, mathematically. I'm not ascribing anything other than its mathematical manifestation over time. But when it's been forever and ever since that happened, it can, and often does, mark the end of whatever has been occurring. It's like a change in the weather. You know, if you've had terrible weather and then all of a sudden there are, you know, mare's tails clouds and things change, well, the next weather pattern is likely to be very different. And that happens here. You know, we had a good long pattern here. We didn't break below 4 in here either. This is longer. This is significantly longer. It's technically 226 trading days. The previous record, I want to say, was 208, and that was in here. But then when it first broke below the green line, end of the cycle. Right, so we still got some gains off of that, but then the market fell apart. I am not saying that that's going to happen here, but I am saying there's a mathematical possibility that this is the end of what has been a very good stretch, and we're going to have maybe a little recovery and then a really tough time. I don't know. No one knows what's going to happen. But when you can look back historically and see that that has been true, it should be a warning and a benchmark for us as to what may happen next. Okay, so Brian, you have... I'll stop sharing, and you may have concluding comments on what's next.
Thanks, Tim. Candace had asked a question.
And I'll do 30 seconds on take 2 as well. I won't forget you.
Oh, sure. I'll ask you one question, Tim, just so everyone's aware of it. A question from Chris, whether an API is available for Market Structure Edge.
We have an API. We do. We've only made it commercially available once. I mean, we're open to it. We certainly are. We don't broadly offer it right now, but we can. That's kind of an open-ended answer, Chris. We certainly have that capability, yes.
Yeah. And I kind of mentioned, part of my point already is I think the road ahead is going to be very dependent on big tech. If big tech weakens from here, I think we could have just choppy trading for a little while. I'll share my screen for one last item here.
Yeah, here, I'll stop.
I hear it.
So if you look at this stretch back in December, this is a good example of what I mean by choppy trading. Broad market sentiment had deteriorated below the green line, so we have an entry point, but the entry point just doesn't last very long. It lasts about 3 weeks, but you can see it was very choppy in its nature, and that's what I'm concerned about is if we don't get buy-in from big tech, I think we have this type of trading, coming out of expirations. It doesn't, we could have some upside for a little while, but I don't know, how long it might last.
Okay, and I will share really quickly here too, if I may, Brian, and I'll make a quick wrap-up comment here. But Joe, to your, so Joe had a question. We provide model portfolios, and they're designed for smaller investors. They're limited to a handful of stocks, like 5 stocks, and they just do. The math does the thinking. Every day we just we run quantitative models that use market structure uniquely.
They're almost done.
Hey, Steve, I can hear you, I think. Good to see you, by the way. Thank you for being here. So this is the performance year to date of the what we call the focus take two model. And so it's done, I mean, it's all over the place, but it's certainly outperforming the market. It's up like 8.5% almost. And so what it looks for are stocks with, here, I'll show you. It looks for stocks with and we, it's a JSON file that we use to run this. It's a model we built, but we look for stocks that have demand of at least 8 on that 10-point scale, with a trend that is either rising or not falling, intraday volatility of 3% or more, because we want to capture volatility. We want stuff that's volatile in this portfolio, not in everything. Low volatility portfolios, we don't want it, but they're not doing well right now. At least $100 million of daily dollar flow. Rather than 1 million shares, we want enough money to get in and out, so it tends to be large caps. The 5-day trend on the supply side, short volume is down, and short volume is less than 51%. And we want at least a $20 price. We don't want low price stocks in this portfolio because they move more. And then we exit if it gains 2% or sentiment deteriorates below 5. The problem with that is stuff can lose ground but stay above 5. If it went from 10 to 5, there could be some substantial deterioration, but it works well. And then every day we just, manifest the portfolio. There were no entries or exits today. This is what it holds, and it's up 8.4%. I mean, it beats, my good friend Terry said, it beats a poke in the eye with a sharp stick to get 8%. Doesn't always work, but it is. We have model portfolios that are created to fit the conditions in the market. As to what's ahead, we'll find out. I mean, I feel like we're right at this. It's a vital juncture. It'll be interesting to see what happens today. The market's doing a little recovery, but we have that last hour. Last hour is pretty important, and it's never linear. When we get to about next Wednesday, we're all the way out of this options expirations cycle. We can have a look, but I think there's the risk the market could correct. Probably won't, but it sure could. And that's all I've got. Any parting words of wisdom, questions? Let's see, Brad, you asked a question. Earlier, you had a chart up with some extra curves. Okay, so that is specific, Brad, to the daily trading. It's more messiness on the screen, but what I was showing is this. If you go into daily trading ideas, and by the way, you've got I can't remember the name of this company, but it's an illustration of how at options expirations things can go south on you. I mean, you always want to check. Brad, this is what we were, it's got the high-low prices, so you get the idea that there's a lot of movement in price. That's the point, and we don't really care where it closes. What we care about is, does it move 2 or 3 or 4% during the day? Take your gain. That's what you're doing. You don't wait around. If you can if you could trade late in the day and then early the next day, you can. It's one of my favorite things to do. You can make money very consistently that way. Now, sometimes I'm just too busy to do that, and so the model portfolios work well. Here's the problem for this one. Even though the supply side is tipped down, this is difficult, and it just got to 10. Right into options expirations. And look at this trend. That's not great either. So I would steer away from that. But that's what I was looking at. And if you look at SanDisk, SanDisk, I've highlighted it. I mentioned it on CNBC. I said, if you want to find something that's doing well, you want to find stocks that are at 10 with declining supply. It's been at 10 a lot, and it performed very well. But it's weakening, right? So you have a long stretch of 10, much shorter stretch of 10. Now it's not even at 10.
Hey, Tim, can you share your screen again? Sorry about that.
Oh, thank you. I'm sorry. And I've taken this over. I'm going to end here. I just wanted to illustrate that. Apologies that I did not show that. And then we'll wrap up here. Okay, so Brad, back to the point. Here's what I was showing. It's these lines, and it's in the daily trading ideas portfolio where you can see there's a lot of movement, and you just want to capture part of that. What I was highlighting is this: CENX, high trailing probability. 6.6% volatility. But today, if you looked at this stock, here's what I was pointing out as the problem. So even though supply dropped day over day, that's what the portfolio looks for. And even though demand hit 10, this is the Hicks rule. Steve, I think you're here. That there's a very high probability that when things hit 10 and supply drops, that you get gains. During options expirations, all bets are off. And this long uptrend on the supply side can show up during options expirations. It could tell us that people are short that stock into resets. Well, you can go look at the stock. I think it's down 11% today. So that's why you got to be careful. What I was saying about SanDisk, very quickly, SanDisk has been just an awesome stock, one of the best performers in the market. And you can see that. I mean, if it's hammering the ceiling at 10, it's probably in pretty good shape. If it deteriorates down to 5 or lower, I would leave. And it really, it's hardly had gains since. So why would you leave your money committed to something that isn't producing returns? Then notice this, much shorter time at 10. It tells you that the demand cycle is weakening. Now it hasn't even gotten to 10. Now it shows up in our portfolio because it meets the criteria. But you look at some of these, you look at this and say, during options expirations, I will not be chasing that. I'm not going to do it. And so with that, this is what we do every Thursday, and we'll hope to do it again with STN. Thanks for being here, everybody. It's always good to see you, and thanks for the questions. See you next week.